Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is about accounting for corporation tax. Corporation tax is assessed on the profits of companies for accounting periods, and that is important. Other kinds of tax like income tax, accounting periods. Other kinds of tax like income tax are assessed on a fixed time period like a calendar year. Income tax runs from 1st of January to 31st of December, whereas corporation tax for companies depends on the company's year end. So that can, just lead to some messiness with time periods. Corporation tax is a tax on the profits of the company, so it is like an income tax on the income of individuals. The standard rate of corporation tax in Ireland at the moment is 12.5%. That may change. There are obviously some of our trading partners are unhappy with that rate of tax. If you are looking at this video from another jurisdiction, then your corporation tax rates are probably going to be different, and also the rules in relation to when it has to be paid and things like that are also likely to be different. So please be aware of this if you are watching this video from outside Ireland. So the rules in Ireland are that 90% of corporation tax is payable 1 month before the end of the accounting period, and the second installment is 9 months after the year end. So most of the corporation tax has to be paid pretty much at the time that it's been earned, during the same accounting period that it's been earned, and then a small part is left till everything is settled up after the end of this accounting year and well into next accounting year. So 1 month before the end of the accounting year, and let's say we have a 31st to the 12th year end, your tax advisors will have worked out your estimated corporation tax. So you may have hired a tax advisor, and coming up to the end of the accounting year, they will have a good idea as to what your profits are going to be and what tax is going to be payable on those profits. You take this estimate, and remember it is still an estimate, and you pay 90% of that estimate 1 month before the year end, and then the smaller amount is paid 9 months after the year end. However, from an accounting point of view, you are going to include the full amount of your estimate in this year's accounts, because that is the tax charge that relates to the profits for this year. So in the income statement, we'll have the profits minus corporation tax, and we want that corporation tax to match with the same profits in the income statement. This means that the profit for the year and the full tax on this profit appear in the same set of accounts. So let's take a quick example, and this example is also in the textbook. Bling Limited, their accounting year end is 31st to the 12th X6. Its profit before tax was 40,000, and we estimate that the corporation tax is going to be 4,500 on that 40,000 of profit. It paid 4,050 on the 23rd of the 11th X6. That is the revenue of specific dates that you've got to make these payments by. So that is roughly 1 month before the end of the accounting year. And then the remaining 450 on 9 months after the accounting year end. So those are the two payments we've made. And the other piece of information is that the full estimated corporation tax is 4,500. So this video is essentially about how do we do the accounting for this, as opposed to where these numbers come from and how they're derived. So the profit before tax is 40,000. In the income statement, we will show the estimate of corporation tax for this year, which is 4,500, and that will give us our profit for the financial year of 35,500. On a month before the accounting year end, we are going to pay our we are going to record our tax liability, which is going to give us our expense in the income statement. We do this by debiting corporation tax expense. We debit it because it's an expense, and we credit corporation tax liability. So at this stage, we're going to have 4,500 as a liability on our balance sheet. However, we immediately make a payment then of the 90%, and on the 23rd of the 11th XX, or I should say at least 90%, the company will have to pay off some of its corporation tax. So debit corporation tax liability 4,050, credit bank 4,050. This is the real payment. It is reducing our liability. We are still left with some liability that we are going to pay next year. On our financial statement of financial position, we're going to see at the end of that year, we're going to see corporation tax 450. That is the amount of corporation tax due at the end of the year. And we will pay off that amount 9 months after the end of the accounting year. And we will do that by making another payment. So we credit bank 450 and we debit corporation tax liability 450. Okay, and that will extinguish whatever liability is left for last year from our financial statements. I guess the other complication comes from the fact that we are using an estimate of corporation tax in our income statement and in our balance sheet. So it is possible that by the time we get 9 months out from our accounting year end, by the time we have submitted all our returns to the revenue and they've looked at them and there's been some negotiations back and forth, it's possible that the corporation tax amount could be either higher or lower than our original estimate. So what do we do about that? And I guess we take a pragmatic view of those kind of situations. If the final tax liability differs from that originally estimated and included in the original accounts, then any differences are included with next year's tax charge. So we don't go back and revise 20X6's accounts. We put in any extra or deduct any reduction from the next year's accounts. We don't go back and revise history on this. We just add in those bits or subtract them from the next year's tax charge. If the final agreement with the revenue was 4,750, that's 250 more than we estimated, then the difference would be included in 20X7's tax charge. So that's it. That's what you need to know for the moment about corporation tax. Obviously, there's an awful lot more to be known in terms of how these figures are derived, and that is, I guess, for other study. Okay, thanks for watching. Remember to like and subscribe if you found this content helpful. Bye.